21st Century Entrepreneurship with Martin Piskarik.
Investing currently is a lot of hang on for dear life when things get ugly. And I wanted to build something that wouldn't be like that. I wanted to build something that would still be able to participate and still be able to fully realize and capture long-term returns in the equity markets, but not expose investors to just devastating losses that become unrepairable for years and years and years. Because ultimately, we know we're going to get the money back as an investor when the losses occur in the market, but we'll never get the time back. And that time is something that we can't replace. And so if we can limit the damage that's done to a portfolio when there is an inevitable drawdown, we put ourselves in a better position to make forward progress. And that's really the genesis of what we're doing here. One of the things that happened to me formative as a young man was having my father, who grew up, I grew up in the Middle East. We had an interesting upbringing where my parents met over in Saudi Arabia, and I was born and raised there. He worked for a big oil company for all of his career and then retired early in his sort of late 50s, and then brought the money back to the United States, invested with an advisor up in Northern California. That advisor had been very, very famous, working with, sports figures and celebrities. And within about a year and a half of investing with him, that firm came unglued and it turned out to be a Ponzi scheme at the end. And my dad lost basically all of his money as a, early retiree. It was a devastating blow to him. And when I look back on this, it's something where I can realize that it literally killed him, that the man that I grew up with was no longer there. He had to go back to work. He was second guessing his decisions. He felt like he'd failed himself and failed his family. It's a terrible, terrible experience. And that also is a really important aspect of what I do, is I don't want anyone to go through a financial loss. It is just a horrendous thing. Now, fraud is one thing that, that's tough. But for some people, that same experience of self-doubt and loathing, frankly, and fear of making another decision can occur from what I would maybe gauge as a relatively modest loss. I say modest being like 20% or 30%, which sounds significant, but it's not everything. It's a pullback in the price. But for some people, that amount of loss is enough to remove them from the equity markets, like forever, and they'll never be able to get back in. So having a structure in an investment process where you can clearly define what the downstroke is and then make an informed decision about whether or not the amount of return you're going to potentially derive from that downstroke is fair, that is a whole different animal to me versus putting your capital out into a series of stocks or bonds and then really not knowing what's going to happen, just kind of hoping for the best. That's not a strategy. That's kind of a hope and a prayer. Structurally, when we're trained as young advisors to build portfolios, the approach we use is to diversify. And we all know that there is risk in investments. And conceptually, the idea is to diversify those investments in a way that not everything is correlated, meaning that hopefully in a portfolio that's well constructed, there's always something going down while something is going up. And the idea is that over time, you can sell the items that have gone up and take some profits and reinvest those profits into something that may have been going down, with the idea that those investments are cyclical and that they will rise and fall independently, and you can kind of have this balanced road to a portfolio appreciation. What I came to realize is that all of that portfolio building is backward looking, and everything in the US under rules and regulations implore investors that past performance is not indicative of future results. We know this, but we're humans. We have to go with something. So we look backwards to try and figure out what we might do going forward. When we build these diversified portfolios, they work well in normalized markets. So when things are going well, then there is this sort of almost like a rising and falling tide. It's not substantial. It's just this up and down momentum, and you can harvest from the winners and top off the losers, and then eventually those losers become winners, and you can top them off. So that's great until there's a crisis, and whether it's the tech bubble, or whether it's the financial crisis in 08, or whether it's the COVID swoon that happened in March of 2020, something comes along, and all of a sudden, all those backward-looking correlations that were not correlated can suddenly become correlated. And it's in that crisis where this portfolio construction that we've branded now as synthequity, it's the combination of synthetic equity. So synthequity is our trademark. And that synthetic equity allows us to attempt to build a portfolio that doesn't have the downstroke capacity, and still can participate in the movement to the upside when it comes. That's really the structure for us, because any other type of portfolio construction, the more pieces you put into the pie, literally really dumbs down the performance. Because if you think about it, if you have 10 investment options, one will be the best and one will be the worst. And by diversifying, you get the average of them all, but you can't by definition do as well as you could have done if you'd just been able to pick the strong one. And the idea is that we can't know which one is the strong one, so we just pick a bunch of them. Well, our approach is different. We look at the S&P 500 as being the 800-pound gorilla of investment performance over the long term. It literally is the US's 500 largest stocks by capitalization, and it's a self-repairing or self-healing index. And by that I mean, as companies surge and do well, they knock the weaker constituents get knocked out of the S&P, and they get replaced by stronger companies. So over time, today's S&P 500 has a lot of the same participants as it did 20 years ago, but there are a lot of newcomers that have knocked out old stalwarts. And so that index is just always getting stronger and stronger based on market participation. It's what makes it such a hard index for managers to beat over time. So we took the approach, let's not fight that. Let's just try and get the full participation. But let's also simultaneously try and stop the only flaw that index has, in my opinion, is that eventually, every once in a while, it loses half of its value. And when the market drops 50%, this is where the math of gains and losses steps in and can crush a portfolio. Because if you've invested $1 million and you've successfully grown it to $2 million, let's say over 3 years or 7 years or 10 years, whatever it takes to double it, it only takes a 50% loss to bring it right back down to where you started. So a $2 million portfolio, 50% loss, you're back to $1 million. And again, it's not so much the capital that you've lost, it's the time. Because that 6 or 7 or 8 years it took to double it is now all gone, and you're back to square one. So we wanted something that would be able to appreciate, and ideally appreciate strongly, but also not be able to get knocked all the way back to the starting line. And that's what synthequity enables investors to do. So I'll go back to, the tech bubble. That was the first genesis of where things went south for me as an advisor. And that was when the markets sold off in 2000. They sold off a little bit more in 2001. And at that time, looking back, again, using backward-looking data, we never had 3 years in a row in the stock market negative. And so as an advisor, I'm assuring clients that 2002 is going to be the year where we get a rebound. And I was sorely wrong, because in 2000, the market went down about 9%. In 2001, it went down about 11%. And then in 2002, it went down more than the sum of the previous 2 years, about 22%. So that's really where I got my first lesson of nobody knows what's coming or when, and no one knows how bad it's going to be, or how long it's going to last. And that was my first sort of gut check that things could go badly and not be, like comfortable. So when clients were calling during that time period and asking, how much worse do you think it's going to be, Larry? It was a miserable experience for me, because I couldn't answer that question honestly. I mean, the only honest answer was to say, well, this is as bad as it's ever been. We're breaking new ground here together. Now that's not comforting at all. That's the kind of response that gets clients to say, well, I want you to sell me out of those positions. Now, they knew long term they'd be fine, and I knew long term they'd be fine. But in the moment, during the crisis, you don't have the courage to stay the course. And I joke about this now because it's been a long time, but the market knows when clients sell. They literally can sniff you out. And as soon as you've, capitulated and sold your position, that's when the market will stage a rally and start to move away from you. So not only have you suffered on the way down, now you get to watch in literally horror as the market recovers without you and moves up and up and up. Now, part of you is going to want to hang out there and go, well, it's probably going to turn around and go back down again. But at some point, whether it's a 5% recovery or a 10% recovery or a 20% recovery, you might have to make the decision to get back in again. And if you do, that's also when the market has sniffed you out and is going to punish you for waiting so long, and will go back down again. And you ride this unbelievable roller coaster of pain by selling low, buying back in high, and then selling out again when it's lower. I mean, this is a disaster. My opinion, if you're trying to hire somebody who professes to think that they're going to know when those changes are going to occur, whether it's AI or just an oracle or a guru, it's a very human characteristic to seek this out. But I'm here to tell you, my belief firmly is that is an accident. If you have any success in that, it's not because it's been done with some foresight that's actually true. It's just been something that's worked out. So when that strategy, or when that soothsayer makes a call that the market's going to go down and gets out, and it doesn't do that, it's just a question of how big the damage is and how long it's going to take to recover. That's my opinion. I'd much rather rely on something that has a structural defense in it that I know is going to work, regardless of what crisis it is, whether it's financial or political or whatever. When you're at a cocktail party and you're just talking, socially, nobody ever comes up to you and says, wow, I just crushed it with my fully balanced portfolio of stocks and bonds last year. I mean, it just doesn't happen. Everyone knows that the people who come into cocktail parties and brag about something have made a highly concentrated position. They've put a lot of capital behind something that has gone up a lot. That's when they want to talk about it. So that's a key point to understand. The risk obviously is severe, because if you put all the chips behind a horse that comes up lame, then you lose a lot of capital. So sizing the bet is super important. But the key thing for me is that concentration of risk is going to be the key to getting forward momentum and growing a portfolio. Now, simultaneously, how am I going to provide defense? Well, the way we do this is by synthetically recreating the exposure to the index. And we do that by having the majority of the capital in our strategy is invested in treasuries. And I don't mean like 51%, but something between 80 to 90% of the portfolio. So the vast majority of the portfolio. And that is where the confidence comes from. Because if, let's say, 90% of the portfolio is held in treasuries, well, what risk is there really? I mean, the risk is going to be limited to the 10% that you have. The conundrum becomes, what can I possibly achieve at a portfolio level with only 10% of the portfolio at risk? And this is where I think most investors just can't think about this, because using, a single stock position, even if it's Nvidia, won't be enough growth to drive the portfolio entirely with a 10% allocation. In fact, a 10% allocation to Bitcoin wouldn't be enough to drive the portfolio sufficiently to move the entire portfolio. What does work are derivatives, options. So we buy options on the S&P 500 index directly. And as an owner of an option, your risk is limited to what you've paid for it. That's it. It can't turn into something else. It can't turn around and affect the treasuries in some way. So if I put 10% of my portfolio in options and 90% in treasuries, my loss limit is 10%. It's even less than that, because over the course of a 12-month period, I'm going to earn something on the treasuries. So I'm going to have even less than 10% over a 12-month period. Measured risk portfolios allows each investor to specify what that risk is. And the more risk you're willing to take, the higher the reward will be if the market's positive, and the higher the loss will be if the market's negative. So it's very, very linear. And all we have to do is realize that the 10%, roughly, that budget, is fully at risk. It's not at risk of a decline in value. It's at risk of total loss. And that's this idea of the concentration that makes this possible. And what I like people to think about is, if we can build something that has a great likelihood of being able to perform similarly to the S&P 500 over time, but without the drawdown risk, then what I'm really framing is a question like this. If I put a 2x4 on the ground and it's 8 feet long, and I ask you to hold on to something important and walk across that 2x4 on the floor, the great likelihood is that you'll be willing to do it and that you can do it, because it's not a very difficult challenge. But if I take that same 2x4 and I now suspend it across two 8-foot ladders, and I ask you to crawl up that ladder, stand up with nothing else except that very valuable thing in your hands, and walk across the ladder and then try and turn around and go back down the other side, that's a whole different risk level. And that's really the way I view the S&P 500 is a great reward capacity potentially, but very risky. And if we can synthetically create something that's down on the ground where it's okay if you step off, you're just going to step off the 2x4 and then step right back on again and not really disrupt your path. That's what I'm trying to achieve with this synthequity concept, is synthetically re-engineering the downside, but leaving the upside intact. The first iteration of this portfolio strategy, we actually started in late 2004, early 2005. We ran across an insurance product, actually. It was an equity indexed annuity. These are products that offer the ability to earn a crediting rate if the market goes up, but a zero if the market goes down. And I was fascinated. I'm literally just fascinated on how can we give clients a credit if the market's positive and a zero if the market's negative. And it was such a simple math problem. I couldn't believe that it wasn't more popular, because you take a zero coupon bond, like where you can invest $95,000, and a year from now it's worth $100,000. And so on a $100,000 deposit, the insurance companies put $95,000 in a zero coupon, and then they spend $5,000 on options. And a year later, if the market's positive, you get back your 100 plus something from the options. And if the market's negative, you get back your 100,000 plus nothing, and you get your capital back. It's only win, no loss. I was stunned, and I realized, wow, this is something we can, tweak with a little bit, because all those parts you can buy them in a brokerage account. I can buy a bond and I can buy options. And when we started to realize that the actual behavior of that product was more like a bond, not an equity, because they had limited the losses to zero. And the only way to do that, frankly, is to sell off some of the appreciation to help finance that zero cost option. And what we did instead is we leaned into the first dollar losses. So we said, listen, it's okay if we lose 5% or 10%, even 15%, because the likelihood of getting out of a 10 or a 15% hole is pretty high. But the likelihood of getting out of a 30 or 40% hole, that takes years. So let's go ahead and keep that first dollar risk, and then we can earn our way out of it if it doesn't work out for us on a 1 year period. Well, that was really the eye opener for us. And we went to a couple of clients that had some large capital with us, and we said, hey, I think we have a math idea that will work. Would you mind if we try it on you? And they agreed, which was great. We got proof of concept in late 2006. And then that's when we formed our own RIA, or Registered Investment Advisory, in 2007. So we actually had a proof of concept right away in 2008. We stepped right into the financial crisis. And unfortunately, we hadn't moved all of our clients into this model. We'd only been able to meet with, a certain number of them. So the 2008 crisis was still devastating to our company, devastating to a lot of clients that we hadn't had a chance to meet with and do this process. But for the clients that we did have it in, it worked beautifully because it was math. It was based on the structure, and so the structure worked. So we've been doing this now for over 20 years. And since 2016, we've gone through the process of getting it our firm now complies with GIPS, or the General Investment Performance Standards. We've been reporting to Morningstar now for many, many years, and we have a great track record with them. We've been able to match on a gross of fee basis the S&P 500 with pretty much 85% of the portfolio in Treasuries or equivalents over the last 10 years. This prompted us to then launch an ETF recently in March of 25. And that ETF now, Exchange Traded Fund, is available on many, many platforms, open architecture. So if you trade on Schwab or Fidelity or Interactive Brokers or any of the major platforms, you can just enter the ticker symbol SNTH and you can find our strategy there. It's new, so it doesn't have a ton of capital in it yet, but from March to now, we're recording this in basically the first week of September. We've raised over $70 million from zero, and that's growing rapidly. And we expect that there is a large appetite for this type of strategy. And firm-wide now, we manage just under $500 million, and $70 million of that is in our ETF. So there's a lot of capital, a lot of intellectual experience that we've brought to bear over many decades. And what's available now is the best of all that. There's more information available on our website, which is measuredriskportfolios.com. And then the synthequity ETF is specifically available with more information there, including daily position holdings, and that's at synthequityetf.com. And I encourage listeners to discuss this with their advisors. One of the things I think is missing in the models right now, options are literally the exclusive tool that can be used to customize risk management. And it's a shame that when we go through our training as an advisor, we arrive at a large firm, almost invariably options are looked at like, oh, that's dangerous. Let's put that in a box and on the shelf where we don't have to talk about that anymore. And I'd encourage you to really seek out and encourage your advisor to talk to you about options, whether it's our strategy or your own customized strategy. But it's the tool that you can use to customize risk. When it comes to risk and risk capital, I mean, we have to put our capital at risk in order to achieve a return over time. Everyone I work with looks back when they get older and say, I wish I'd taken a little more risk. Because the reality is we're too afraid of it. And we're right to be afraid of it. But if we have a structure that helps mitigate that risk, we can lean into it and really enjoy the long-term benefit of compounding that comes from the S&P 500 and the equity markets. And this is the safest way that I've determined to be able to expose clients' capital and be able to still sleep at night.
'21st Century Entrepreneurship with Martin Piskarik.
Imagine a space where triumphs, trials, and tales of entrepreneurship come alive. Welcome to the 21st Century Entrepreneurship Podcast. a gold awarded journey hosted by Martin Piskorik, connecting with listeners in 95 countries and ranking in the top 0.5% of all podcasts. Join our exclusive community, elevate your perspective, and embark on the path to success.